Welcome to Investing in the US. My name is Reed Goosens, and we're coming to you live from IIREC, the Intelligent Investor Real Estate Conference here in Manhattan Beach, California. And today I am sitting down with Ryan. Ryan, welcome to the show. I haven't seen you in a little while, but you have not actually been on Investing in the US podcast. So,
no, I haven't. Yeah.
So welcome.
Thank you.
Mate, I've known Ryan for a little bit of time now. He's with Spartan Investments. They're a self-storage operation. We're going to talk a lot about how they've scaled from nothing over the last couple of years and what they're going to be doing coming here into 2022. But Ryan, for those people who don't know who you are, maybe give us a bit of a background on where you've come from, how you got into the real estate space, and you know what you sort of have built to this point. There's a lot of questions in there, but let's just start with the where did you come from?
Yes, thanks, Reed. I appreciate that. We started as a residential developer, and I have a previous background as an airline pilot, and so lived in DC for a number of years and met my business partner there, and we started and scaled Spartan Investment Group, focusing on development as a core competency, and eventually we picked an asset class, which is storage, that we could scale our business from, and that's really been a nice asset to be in.
And when you say development, what were you doing in that space? Because I also was in development, structural engineer. Went to work for a developer here in Los Angeles. But yeah, what was your background in the working in the DC area?
Yeah, so Scott, my business partner, had some background in building houses and some in development. But really, we just dove in and we started building houses from the ground up. We did some land entitlement deals, and just sort of worked our way through the process and got into condo development, where we would take a townhouse and convert it into multiple condos, et cetera. But really, when we started thinking about storage, we've gone on to develop thousands and thousands of units of storage, and we focus now on buying existing self-storage and then adding on to those units. But we also do ground up development. So when you ask kind of our background and experience, has been to surround ourselves with people like you who have a structural engineering background, who are a civil engineer, who are an architect, and we assembled a professional team of trades to come together to help us design the project in a way that conforms to the underwriting and the best, highest in use to build the best, most profitable storage facility we can build.
And I've said a few times on this show, for those people who have listened for many, many years, I always think of investments like the food triangle, right? So think of the good foods on the bottom, and then as you go up the stack, development being at the peak, being the highest risk, but it's also a part of the portfolio. Sure. But as a good foundation, you always want to be putting in cash flowing assets. So having that background in development, and knowing your personal story, obviously development is just one arm of what you do, right?
Right.
But having that good foundation of cash flowing assets, of buying existing assets, talk to me a little bit about that, because that seems to be where you've really scaled, right? That's where a lot of groups, including myself, we've been able to go out and build a company quickly to then go and do cool, sexy stuff like the construction at the top, which is higher risk, takes longer time. It doesn't yield, it yields a lot of money, but it's not cash flowing from day one. So talk to me a little bit about the existing buying.
That's interesting you say that, because I feel like we ate the dessert before the main food groups.
Right.
We started with development and then got into cash flow.
Got it. Okay.
So, it's tough. I mean, for a new developer who's thinking about building a new storage or building anything from the ground up, you've got to have the cash and resources available. And what a lot of people don't think about it, and we know this in the syndication space, is you've got to you've got to charge a developer fee for that project.
Yep.
Or you're going to end up working at Starbucks on the weekends.
Yeah, because it's so labor intensive. You have to have a payroll very quickly.
Yes.
To deal with the cities, to deal with the GCs, to deal with entitlements, and that's before you even put a shovel in the ground.
Correct.
Right? And that can take years.
Yes.
Right. So you're only one person, and I just know from experience. I was employed in a former life as an entitlement person. Right. I would work for the developer to go running around to the city, hassling them to say, "Hey, come on, let's get this project going."
Hey, we're hiring for that.
Yeah, right. Yeah, exactly. Here's your W-2 back. Yeah, no, thank you.
We'll put you into some deals.
Yeah. So then talk to me about that transition into we'll call it the foundational food group, because I think that is where people And I want to get into your scaling and what you've built today.
Sure. Yeah, getting into the cash flowing assets has been very helpful to producing monthly reoccurring revenue for your business so that you can continue to scale and hire. And, it's very difficult to start with ground up development to do that. Again, charge the fees, make sure that you have some kind of reoccurring revenue so that you can fuel your company to be successful. When I look at somebody who's doing ground up development, I always make sure that sponsor is charging fees because I want to know that person's paying attention, has the resources to pay attention to that project. So our pivot to cash flowing assets came when we met Ben Lapidus.
Got it.
Ben had a strong financial background, really understood cash flowing businesses, kind of more M&A, mergers and acquisitions. That's kind of what we're doing, right? We're buying a self-storage business, we're taking it over, we're bringing it into our portfolio. And I think that transition really comes with the requirement to have a strong financial background. You've got to have a very strong finance team. Mm-hmm. You've got to have great CPAs, great accountants, great cost study companies, and you've got to have a good year-end process for your taxes. And, are you sending out monthly distributions for that? Because if you're getting into cash flowing assets, investors are going to expect some kind of a frequency of distributions to be interested in our cash flowing deal versus somebody else's, due to your investments quarterly or distributions quarterly or monthly. And I think having those processes down really helps, get into that space and be successful at it.
I'm going to pivot back to the self-storage niche and Jen from a high level, just for the podcast, just for the listeners out there. Give me a 30-second to a minute pitch of what you're doing and why self-storage is a thing in the United States. I know we spoke about it yesterday, where it first came from, and where it's come to. And I want to get back to the scaling of your business because that's really important and part of what I love talking about. But let's, just for the listeners, talk about why invest in self-storage.
Because self-storage is based on life events. So age, relocation, downsizing, putting all your stuff and hitting the road in an RV, death in the family, expanding your family, job relocation, etc. It's a disruptor asset class. It's not just because Americans have too much stuff. Americans have too much stuff for sure, but it's not just that. It is the world happens, and when there's bad things in the world that happen, like COVID, people are going to use self-storage more because there's more change in their life. My example that I give is I don't like self-storage. I don't like using self-storage. I don't mind it. But I use self-storage right now because I have a growing family. I'm renovating and expanding my house, and I needed to clear out my belongings and put them into self-storage. And I thought it'd only be a three or 4 months, but like any development, there's always mission creep. And so now my stuff's been there for like 6 months. But people are always going to use storages, and businesses use storage. So probably 30% of our customers are furniture staging companies, contractors, little league teams, chamber of commerce, whatever it might be. People need self-storage not just for stuff, but they need it for business use. There's a lot of HOAs and covenant restrictions now on new home developments. So you can't put your utility truck in your driveway anymore. You got to put it in a storage facility.
Interesting.
So I think it does really well when the economy is booming and people have a lot of things. It does really well when the economy is being disrupted. And that's why I think if you look over the last 4 dips in GDP, self-storage occupancy has been perfectly consistent. Hasn't dropped, hasn't followed GDP at all. It's completely uncorrelated asset.
Let's talk a little bit about the investment side of it and what makes a good self-storage. You and I were speaking yesterday about the correlation of the square footage availability in a sort of 1, 2, 3,
Sure.
4 mile radius, and maybe talk a little bit about where you're investing around the country. Like, are you investing in Los Angeles, or are you investing in secondary and tertiary markets?
Right. So we stay in the tertiary and secondary markets because if you're going into the primary markets, you're typically going to run into saturation problems. There's overbuilding, a lot of competition, it's expensive, and if you get past all that, you're going to be head-to-head with a REIT, public storage, extra space, life storage, whatever it is, and they're going to be better capitalized than you, and they're going to basically eat your lunch. So as a smaller operator, even with our size, with $500 million under management, we don't like competing with those. And you might just say, well, why don't you just hire that property management company to run your business. But we all know that property management companies is just an acquisition scheme. They control your facility and that they control the value, right?
And just say, I'm just going to jump in because for those people listening, what do you mean by that? Because the majority in the multifamily space, we go out and hire a third-party property manager, right?
Sure.
In what you were telling me yesterday was that self-storage, if you went out and hired a third-party property manager, it nearly sounds like predatory lending, that they're sort of, it sounds good, great, you're going to manage my asset for me, but actually tell the example that you were talking about.
Yeah, so, and I'm not talking about, smaller property management companies and the kind of the one-off stuff. There's definitely property management companies out there that are well-intentioned. But what we saw through the pandemic, a very large self-storage company, I won't name them by name, cut their rates by 50% and artificially lowered the revenue on a lot of these properties during the pandemic, where we had rising rates, the highest occupancy the industry has ever experienced, and self-storage was extremely successful. Why were they cutting rates at all of their stores, and the owners had no control over it? So we saw a lot of those facilities, those flag facilities, go up for sale, and then we bid on even one of them, and at the last second, that property management company came in and made an offer on the property because they knew that the T12 had been beat up for so long.
Because they controlled it.
Because they control it.
Wow.
So that they could come in and immediately add value through having the rate increases. At the end of the day, we do our own property management. We have our own brand because it's a risk mitigation strategy. We focus on NOI. A property management company, there might be a little bit of misalignment because they focus on a percentage of gross revenue. So it's just a strategy. That's why one of the reasons why we chose self-storage as a vertical, because we knew that we could build a proper, PropCo inside of Spartan to do that. Right. And other than that, I think it's just, we control the whole process, and it helps with the investor experience because we have a little bit more say over it. Exactly. Yep.
Talk to me about the metrics of that self-storage we were talking about yesterday, about the price, not price per pound, the self-storage requirement per person in an area. So when you go into these secondary, tertiary markets, what are you looking for in that metric?
Sure. So the easiest way to explain this is in the United States, the average square foot per person is about 5.2 or 5.4 per person. So let's just use some round numbers to make this easy. Let's say there's 100 people in the room and you have a 5 square foot average utilization in that room. That'd be 500 square feet.
Yep.
Right. And let's say that there was 300 square foot facilities around that room. Well, your unmet demand is 100 square feet.
Right.
So then you have to look at, okay, how many square feet do I want to build, and do I have the demand to go into that market? So when you look at self-storage, if you're in Indianapolis, or Indiana, where they have basements, the square feet per person may be a little bit lower on the saturation.
Right.
But if you go down to Texas, where there's no basements, the saturation number might go up into the 20s.
Right.
So when you look at a property, you can't just say, well, the national saturation is 5. You're saying it's 20 down here. That seems very oversaturated.
Right.
It really depends on the market. So you've got to look around at the surrounding cities, get benchmarks that provide you with the demand, and then see what the demand is at your subject site and what people are using in your market to determine an over or under supply of storage. But really, we mystery shop all of the competitors. We look at all the pricing. We try to make sure that we understand the whole market, do a whole feasibility study to make a conclusion. That demand number isn't just the conclusion. There's many factors that play into that number, other than just the saturation number. It's just a good, kind of pulse.
Sure. So just to repeat it for the listeners, if you're in an area, if you're looking, let's just choose anywhere, in a 5-mile radius, you have 10,000 people who live in that area, and you might have 5.2 need of square footage per person. So you're going to have 10,000 times 5.2, 50,000 square feet need. You then would go in and look at all the self-storage facilities in that 5-mile radius, and you would deduct and then see whatever the delta is. If you had 4 10,000 square foot storage facilities, well, you know that there's a delta there of 10,000 square feet that needs to be filled. So with that being said, are you building or are you buying existing when you look at that, if there's a discrepancy?
Sure. So no matter what we do, we always do the study.
Yep.
And I will say that we've done the study, and we found that the study didn't match reality on both sides. Wow, we have so much unmet demand in this market. We're gonna kill it, and it goes okay.
Okay.
Sometimes we say, oh my gosh, we wouldn't do that property because it's got bad numbers, bad demand numbers, and we'll look at it and we'll find a story. Maybe it's a really bad operator or just a really, maybe we just don't have good data. Sometimes there's gaps in data. It's not perfect. So if you can find a story, sometimes it works out a little bit better. So that data is just kind of where are we at? And there's a million different ways to manipulate that data. And I really wanted to stress that.
Right.
You mentioned radius. Mm-hmm. 1 mile, 3 mile, 5 mile radius around a storage property. That's as the crow flies.
Right.
So what we do, what makes us unique, is we actually paint a drive time map.
I like that.
Right? Because if there's a lake there, you can't capture those customers on the 3 mile circle because it may take them an hour to go around the lake or whatever it might be, right?
Yeah.
So, that number is, so if you shift it to a radius look versus a drive mile look, your numbers are going to change. Right? And if you use, which cities should I benchmark? Should I use those 3 cities or these 3 cities? That city's like way over here, this city's way over here. So again, you make small little adjustments to the data and you could get a wildly different result.
Right.
So we're constantly looking at that. So we send our team there. I mean, that you have to have your team. You have to have boots on the ground. You do the desktop study, sort of get a preliminary look, and then you go see what's happening. You go look at the vintage of your comparable facilities. There's all these different things you have to do to make sure that, hey, this matches up or this makes sense.
Sure. I love that. I'm very data driven. So coming from the multifamily space, there's a lot of data out there, CoStars of the world, Acmetrics. I assume they have that in self-storage?
Absolutely. We're CoStar customers. You can look at Radius Plus as a metric. Yardi even has a lot of reports. They're kind of getting into the self-storage space. There's tons of different software and data, and a lot of it crosses over with multifamily. We're looking at drive time data, population data, growth data, and we only look in markets where there's population growth.
Right.
So we looked at the 4,500 metropolitan statistical areas in the United States, and we said, okay, which ones have the highest population growth, the best rents for self-storage, and generally a net migration of jobs and income and positive things. And we narrowed that down to 150 markets. It's on our website, and that's where we look. So we don't look in Michigan. We don't look in most of Ohio, with the exception of maybe Columbus, because most cities are shrinking population in the state. We don't look in New York, or Jersey. I'm not saying that there's not a good product there.
Yep.
But most of our properties are in states like Texas, Tennessee, Georgia, Florida. We're in Wisconsin, but we're in the highest net positive counties in the state of Wisconsin. Wisconsin's growing, and then we're in Dane and Waskasa County, which are the 2 highest net migration of people. So we're looking where people are going, because people are what drive self-storage businesses.
Sure. Yeah. No, I love that, and thank you for explaining that. Let's now pivot into the growth of the business of Spartan Investments.
Sure.
I've known you guys for many, many years. I know Ben quite well, one of your founders. Talk to me about the growth, because you're at $500 million right now. I know in the beginning, maybe like all of us, starts a little slow,
right.
But now you've got a lot of employees, you're vertically integrated, you've got your own property management company, you've got your own construction company. How has that been, and what investments have you had to make over the years? Because we were talking yesterday a little bit about your acquisitions team, but maybe just from a 30,000 foot level, how's the growth been over the last 4 or 5 years?
Yeah, so I would say there's been a couple of ingredients. The number one is culture.
Yep.
Mission, vision, values, and focus on culture and making that the number one important thing. So whatever that might be, at our company, we have a saying, invest in our values, and our values are driven by our grit. And our grit is defined as growth, respect, integrity, tenacity, and transparency.
That's great.
And every week we recite the values as a company at our team-wide meeting, and we ask about how we're adhering to those values, and we try to live those day in and day out. And it makes it easier to identify who would be a good fit as an employee for our company.
Yep.
We ask them, how do you identify with the values? Which value do you maybe least identify with?
Sure.
And you can really tell a lot by somebody who, if they've really done their research on the company and really want to work for Spartan, we can tell if they're a great fit.
I think it's so important as you're going out into the marketplace to hire good people.
Yeah.
To have that being at the forefront, or if you don't meet these sort of criteria, or you're not on board, you're not going to get the job. But talk to me a little bit about all of us are entrepreneurs listening to this. You get to a stage where you think, I need to scale this business, which will require money. And also money comes from deals.
Right. Yep.
I might not have all the deals yet. Right. But I can go do more deals with more people. And so there's this dichotomy of like where you're sitting going, should I spend my hard-earned cash on employees to help me go, instead of riding a tricycle, you now in a car, or from a car to a jet plane in terms of how fast you're moving down the highway.
Sure.
Talk to me a little bit about that and that decision in your organic growth.
Yeah, so I'll speak about it personally and then as a company.
Yeah.
So for me, I've always been a deal guy, and that's how we all are, right? We get into this business because we hear about somebody buying a multifamily building and making lots of money or whatever it might be, and you just have this endless pursuit of doing a deal, and you do all this work, and maybe you do a lot of work for a couple of years and you don't get paid very much, and then finally
it pops.
And the last thing you want to do is go, okay, here you go, employees, and then try to get more and scale. So it's really difficult, and there's a lot of friction among your business partners, your employees, your work-home life balance. I mean, it's not easy,
Yeah, no, I know.
and it's a real struggle. So I feel like, with this syndication model and the way we've structured our businesses, it's really helpful to have acquisition fees.
Yep.
Because, you're spending your acquisition fees on making strategic investments in your company, which is hiring people. It's building an office space. It's sending people to conferences. It's advertising, right? So all those things that you spend money on, it's no longer about you being savvy in multifamily. It's you being savvy in making strategic decisions in your company that will fuel its next growth. Think about, we just read the book, the whole company read the book, Who Not How. That was kind of our latest book. And, my biggest struggle is, well, how do I do that? How do I go about, building a big capital program or finding lots of deals or hiring lots of people? But really, that's not the right way to think. You need to be thinking about who do I need to find to help me build my HR program, which we just brought on an HR specialist to help with our hiring. Our marketing, who do I need to help? So we brought on a director of marketing who has experience, building brands.
But this all costs money, right? In the beginning, so tell me about that first dollar that you reinvested.
We invested the first dollars into accounting, and marketing.
Yep.
So we had operations already in house, right? So we had, Scott and I, Scott being our CEO, setting our strategic vision, building the company, having that focus. And on development and building stuff, he's really good at that. So Scott that was kind of his thing. Ben, finance, CFO, underwriting, acquisitions, sort of that whole, more of like a CIO in a multifamily space, just kind of that whole well-rounded asset management, et cetera.
Yep.
We had Jackie, who was focused on operations and, hiring people and, monitoring.
This is in the property management side?
Yes.
Yep.
And then we had Lindsay in the business intelligence side, and then I was in the capital raising side. So now we're like, okay, we kind of had that.
All seats were full, I should say.
Yeah, sort of at the leadership side, right? And then it was like, okay, what do we need help with? And it became very clear that we needed the finance, bookkeeping. And you have two types of finances in this business, corporate finance and property level finance. And you need to make those delineations very quickly and delegate, okay, we need a property level accountants and accounts receivable and payable, maybe even a controller. And we also need corporate finance. How are we doing as an organizational unit? Because that becomes very important when you scale employees.
Sure.
You need to have payroll. You need to make payroll, right? So I think that strategic investments in employees that are in finance and accounting is very beneficial. I think that's the foundation, because think about it. If you don't have clean books, if you don't have tax returns done, if you don't have reconciliation correct, you can't get loans.
Right.
And when somebody's looking at your company to invest or whatever, it really can get messy in a hurry. So once you have that down, you have some operations and deal finding and all that. The next person is marketing. Marketing at the property level, marketing the company.
Yep.
So And really, we made more, as we started it, and then it kind of scales from there. You start putting the building blocks in place, right? Like, okay, now we have all this. Now we have more properties in our portfolio. Now there's more of an operations need. Okay, so we need to focus there. Now we have more properties in our portfolio. Now we need more. Now we need more lenders, right? So now maybe your focus shifts to capital markets, and who's going to help me there? The who, right? Now, how am I going to get all those loans? Who can I hire? Who can I contract? Who can I partner with to get those loans?
Yep.
And then now you have the loans of the properties, and now you got to start building all these things. And who's going to help me build these facilities? So we brought on a director of construction to build our construction company. And this person had, Aaron Saunders is our director of construction, 20 plus years experience building industrial for Casey Industrial. Very, very talented individual, very sharp guy. So we started building out the construction company. And he leads that effort with Garrett Von Manen, who's our project manager. So those two have built the construction company, right? And
these are all W-2 employees, right?
Correct.
Yep.
Yeah, and partial owners as well. We share in the ownership of the business and also in perhaps equity in deals. We've really focused on incentivizing, motivating, and making sure that everybody's in alignment to move forward together. And that's really important, especially in the beginning.
Right.
Those first few hires have to be, really good. So I think that, and then it's like you have all this construction, then acquisitions all of a sudden becomes more successful. And now, instead of raising $50 million this year, you're raising $120 million.
Wow.
So now,
awesome.
So now what do you need? You need more
deals.
More investor relations.
Yes.
Right, we're reacting to the deals, right? The deals are coming in now, and it's like, oh, wow, we've got all these investors, and we need to take care of them, and we need to give them an experience. So then you start building out your capital team. And so you just, at the beginning of the year in December, when you're thinking about planning your next year, think about where is the biggest gaps in the organization.
Yep.
And the number one way we've helped kind of shape that is through Scott's leadership. And also we've added advisors to our company and a business coach. And
who's a business coach?
Ron LaPointe.
Okay.
Yeah.
Through Traction? What is it called? EOS?
EOS. Yeah. And so he helps, everybody's got ideas and everybody wants, they're caught at it. But really, what is going to be the number one thing that changes the business? And we do rocks every quarter. Yep. We do company-wide rocks. We do departmental rocks. What is your department going to achieve this quarter? When we do a company-wide rock, it's that's the rock that's really important, that goes across the organization and needs everybody to pitch in, right? You might need marketing, you might need finance, you might need IR and acquisitions to pitch into that. So I think, having a planning meeting and strategic planning for the year to identify gaps is what's helped us. And what we did in 2020 was we identified that we had the investors, we had the operations team, we had the marketing, we had everything, but we didn't have enough deal flow.
Right.
So we made it
which would just going to jump in, would be a cash flow issue if you've got payroll.
Right. Yep.
So you have these people, you have this team, but then you're like, oh crap, I've got to pay them.
Right.
Shit, where the fuck's the deals, right?
Yep.
You need to be like, oh crap. So because where I'm going with this is that you don't want to then have to do deals to pay your overhead.
Exactly.
Which is very, very, as a growing company, you've got to be very careful with that because, particularly in the syndication space, you don't just want to be shoving another deal down your throat just to get the fees to pay everyone.
Correct. And so we hit a very important milestone at Spartan in 2020 where we were profitable at, all our investments are profitable, but at the corporate level, we paid all of our salaries and overhead and made a profit.
Fantastic.
Which was great. In 2021, same thing. We hit our revenue goals. We had a company-wide goal at the Spartan level, not the portfolio level, at the Spartan level to make $10 million in revenue. Mm-hmm. And I think we ended the year with like 12 or 13 million in revenue. And that was stretch goal. This year across all business units, we want to hit 120 million in revenue.
Wow.
That's construction, property, the whole thing.
Yep.
And one thing that you got to think about is, when you're buying a deal, it's like the bank account fills up with the acquisition fee, and then you spend it all on payroll.
Yeah.
And then you buy another deal, and the bank account fills up with acquisition fee, and you spend it all on payroll. And if you're not selling assets, really the general partner is not making any money. they're just sort of
you're not getting a paycheck.
Right. You're just sort of building this thing, right? And getting the assets under management. But what's great about having a propco, property management company, is you get the reoccurring revenue.
Yes.
And so at some point, you're going to scale and be efficient, right? And you don't got to really hyper focus on efficiency, but all of a sudden you're going to have the monthly reoccurring revenue
that can cover your costs.
So for the first time, and Spartan Investment Group is starting off 2022 with enough monthly reoccurring revenue that we don't have to buy a deal in 2022 and we'll make a profit.
That's fantastic.
So all of our overhead. Now, we're not just going to sit back and not do anything.
Right.
So we're going to be making strategic investments in new hires this year. And it's a very, one thing you want to do is you want to build out your future state org chart.
Yep.
Okay, who do I want to hire this year? And what departments do they need to be in so that everybody's on board? And then you can kind of roll that up into a budget, and say, okay, if we hire this many people, this is kind of what our payroll is going to be. But we're in growth mode. And I think what's really neat is in this business of syndication, you can grow without outside capital. I mean, at your company level, right?
Sure.
We haven't sold shares in Spartan, or taken debt on Spartan or anything like that. So I think it's a really cool model. And
it's a very cool model.
Yeah.
I guess the question for you is, how big do you want to grow it? Because obviously a lot of people get involved in this space to get time freedom.
Yeah.
Right? And then you don't want to ever create yourself a job.
Right.
So how big is this getting?
Sure. So every day I try to make it not a job, because it's, you're hiring somebody. If you're doing a lot of something, you should be thinking about who should be doing that instead.
Right.
So you can stay strategic and you can provide more opportunities for more people.
Right.
If you're getting into the weeds on deals or into the weeds on work, you're not providing opportunity because you're doing that job instead of just hiring someone to do it and creating more opportunity, right?
Yes.
So don't think of it as, I got to do everything. That's really, it's hard for me because I'm a hardworking guy. So I want to do everything myself, right? And so it's
that 80-20 rule is like, fuck it, I'll just do it myself.
Right.
It's going to take me so much time to teach you. Just give it to me, I'll do it.
And I got to slow down and tell myself it's worth it.
100%. It's definitely worth it.
Yeah, it's worth it. It's very empowering to somebody else, and it's worth it for me. So where do I want to go? Our vision is to enrich the lives of anybody that works for us and all of our investors. Anybody who's in the Spartan tribe, we're going to enrich their lives. And that means many different things to many different people. So it's someone buying their first home as an employee, it's an investor becoming, a multi-millionaire. It means many different things to many different people. But what we've summarized our big, hairy, audacious goal of long term is we want to touch 100,000 investors.
Wow.
So, self-storage is our thing. We're going to continue making that our vertical. We're going to focus on it. We're going to be good at it. But at some point, the portfolio might sell. It might turn over. It might turn into something else. We want to go into different verticals. We want to go into private equity. We want to go into, maybe we'll go into multifamily or office or industrial or life sciences or whatever it might be. But we know that having an investor base is what gets you there. Because if you have the money, then you can build the company. And I think there's a lot of debate about what comes first, the money or the deal.
Right.
And I think hands down, unequivocally, it's the money. Because if you have the money, you can hire these people.
Right.
If you can hire these people, then you can get the acquisitions team. If you have the right acquisitions team, you can
support the team. You can buy more people, get more people on board.
Right. Exactly. So, it's not, I was talking to some people at the conference this week, and they say, yeah, I got all these investors, but I don't have any deals. And I was like, well, how much could you raise right now? And they're like, well, I don't know. And I'm like, okay, $1 billion portfolio lands in your lap. It's yours for the taking. Can you do it? No. Okay, well, money's the problem.
Right.
Because what if that deal, it's unlikely, but what if that happened, right? So I think if you just focus on building your investor network and building your company to buy assets and to manage and to run, I think you're always going to have that ability to scale and grow.
Yep, I completely agree.
Yep.
As we're going to wrap the show up, one last piece of advice you can give to everyone listening who wants to get to your level, what is it?
So we do strategic planning every 3 years, and if you want to download a copy of our strategic plan, I highly recommend you build one, and that will help guide so many things. Scott, his background in the military, helped us build that strategic plan through the military strategic decision-making process. And he put that together. And so if you're just getting started raising capital, or if you're not really sure where you want to go, going through that strategic planning process will help investors come into your network because they'll see that you have a vision, and it'll help guide where you go over the next few years and keep you on the straight and narrow, keep you focused on what's important.
Love it. And we're getting a bit of background noise here, so sorry for everyone on Instagram and listening to the show on across all the platforms. But Ryan, where do people go if they want to get more involved in your sphere? Where can they reach you? Where do they go?
Yeah, I'm on LinkedIn, and also our website is Spartan-investors.com.
Spartan-investors.com. Well, look, mate, I want to thank you for jumping on the show here live at IIREC 2022. I wish you all the best.
Thank you.
And I'm just pumped and excited for you to see where you're growing and to know where you've come from, because I think that's really, really important. So, again, thank you guys for tuning in to continue to grow your financial IQ. It's what we're all about here on this show. If you do like the show, give it a 5-star review on iTunes. And we're going to do it all again next week. So remember, be bold, be brave, and go give life a crack.